Okay, we're going to continue on from our lecture notes from the module one. And if you remember this, we had briefly begun to go through these. We mainly looked at the definitions of the primary accounts, the parent accounts, the assets, all the way through expenses. And then we talked about the 7 steps and then the financial statements. Well, we're going to hit the rest of these notes today in quite a bit of detail. And then so that's still located here in the module 1. So if you don't already have those pulled up, go ahead and get those pulled up. And then you'll also want to have the T account page that's in there, the T account attachment. It's an Excel sheet. Looks like this. And we're going to be putting together some journal entries today and putting them into the T accounts with the ultimate goal of preparing a trial balance. Because remember, that's what you use. You use the trial balance to then make the financial statements. So we're going to have an example of that today, where we're going to do that. When you go down to module 2 instructor notes, I only have one item in there right now. And that is the example we're going to go through today, the Taylor's example, number 1. We're going to go through step by step of that. And then our final segment, and or maybe 2 segments, because it's a lot more material in Connect, in the practice. We're going to go through the practice. We're going to look at some of the different items in there. Some of them take a little bit longer, and so we may break it up into 2 segments. But that's kind of an idea of what we're going to be covering today. So let's go ahead and just jump in. What I'm going to have up mainly for the next 10 minutes or so are these 2 items, the T account sheet, and then my notes. So kind of a review from what we did in our last session. We're always going to be using this counting equation in some way or form. It's just something you're going to have to memorize. It would just be good if you go ahead and memorize it now, this early on. Knowing that, as you would have seen in the chapter 1 homework, if you've gotten to it by now, this side over here, the assets, have to equal everything on this side. And then knowing that the fundamental equation actually stops right here. And then later, when the business starts, it starts up for the year. These guys get added in, the revenue and expenses. But eventually, they do end up down here in owner's equity. So that's how the fundamental equation, the absolute basic format of it, is just these 3 parent accounts. But in reality, we also add these other 2 out here. Okay. So now the next step, once we have the accounting equation memorized, we've got to memorize this, the T account setup. And what I mean by that is the plus minus. You'll notice the easiest way to remember these is the 2 on the ends look the same. And then everything in the middle is just the opposite. They're all the same. The plus side is what makes the account go up in value. So anything underneath the assets, so we come over here to see different assets to help us remember. Cash was the biggest one. It's one of the most important. Remember, the AR is receivables, account receivables. You're going to be receiving money. So you want that number potentially higher. You want to be getting more money. So anything on the left-hand side of an asset, or on the left hand, and then we'll be referring it to, from here on out, the debit side. That means it's going to increase the balance. Now, when I say debit and credit, debit does not mean increase, and credit does not necessarily mean decrease. As we'll see in the assets, yes, debit does mean increase. But when we get over to the liabilities and the owner's equity and the revenue, you'll see that the debit is still on the left, but the debit side means actually decrease. So that's one of the first hurdles a lot of accounting students have to get over, is debit does not mean just increase or just decrease. Now, when you think about it from your banking account, your own personal banking account, you can't use that analogy to help you transition into accounting, because the banking When you use your debit card, what you are probably thinking is, I'm using my debit card to take money out. And then in accounting, when you debit something, you're actually putting money into your account. You're getting more money. Now, there's a reason why they call it a debit card, because it's from the banking perspective. When you take money out of the bank, what you're basically doing is removing their liability to you. So the bank is going to, when you have $500 in your checking account, the bank's going to look at that as, if it was me, AP Professor Vanesky at $500. And it would be a plus. They owe me $500 because I put the money in their hands for safekeeping. Then when I go and use my debit card and take out $40, they're debiting my account because they owe me less money. Now they only owe me $500 minus the 40. See the minus over here. And so the balance would be $460. And then when you hear the word, oh, they're going to credit my account. Credit means they now owe you back that money. Let's say they mistakenly took out 40, but I never took the money out. So they're going to credit back to my account $40. So they're looking at it from their perspective, the bank's perspective, not your perspective. And so that's why it's completely different. If you've ever worked in a bank, accounting can be very tough because everything is backwards from what it's not really backwards, but it can seem backwards because now you're looking at it from the customer's viewpoint instead of the bank's viewpoint, which if you worked as a bank, you're used to looking at it from the bank standpoint. And even us as normal users of our credit cards and our debit cards, we're used to looking at it from the bank's perspective. That's just how we have grown up. That's just the terminology that was used. But in accounting, we want to get rid of that and know that debit means left, just left, and credit means right. Then we have to remember that it's the two items on the end, the assets and the expenses, that are the plus minus, plus being on the debit side. And then everything in the middle, the plus is on the credit side. Okay, we're gonna really be using that later today when we start our journal entries and T accounts. Now, let's come down to the bottom, the second page. What we're gonna be doing today are these two steps. We're going to be preparing the T accounts and the journal entries for transactions. And then when we're all said and done, we're going to finalize it and put everything into a trial balance. So that's our goal today, where we're going. We did this back in our first lecture. We did the financial statements. So now we're going to be covering steps 1 and 2. So it takes me down here to the final piece of page 2. In a business, everything that happens, even if cash isn't necessarily involved, needs to have a journal entry. If something happened in the business and there was you got something, you earned something, typically those are the two things that happen, you're going to need to have a journal entry involved. Everything gets a journal entry. So a journal entry, what that is, and I'll pull one up just so you can have an idea. They look like, if they were laid out, they look like this. You have a date column over here, and then you have your transaction column, what accounts were used, and then you have how much was used in each of those accounts. Okay, then so notice here, our debits, when we do journal entries, our debits are always going to go first, and they're always going to be on the far left-hand side. Credits, anything that's a credit amount, always gets indented, like a paragraph when you're typing out a new paragraph. They get indented, and they're always last. And that's just for all accountants use this. It's for easy reading. You can easily look at this and know which is a debit and which account is being credited. And then the other key thing here is I always like to skip lines. The computer program is going to do this for us when we go into Connect. But if you were doing these on your own, you don't want to have these all jammed up, because this is how somebody goes back and looks at your books to see if you have everything done right or if there's a mistake. And if you have everything all crammed together, it makes it a lot more difficult. And then what we do is we take these amounts that's in our journal entry and we transfer them over to our T account. So when we get to the practice example in just a few minutes, we're going to take this $30,000 debit and then move it over into a $30,000 debit in my T account. The T account, the whole purpose of the T accounts is to keep track of your balances as you go. Just like how I had over here in our transaction before I had maybe the money put back in. This is telling me if I was ready to make a balance, I could make a balance right here. And then my balance would be $460. That's how much left. If this is the accounts payable, this is how much I would owe my vendor, how much I still owe them, $460, because it was 500 plus and then minus 40 bucks. So when I combine those two down here in a balance, that's where I get 460. Okay, so then you might think, how do I know which accounts to use? Well, that's where I get into this, the two questions to ask. And if you get these in your head, these are the two, and they almost always work. Sometimes you have to kind of think about it in a little bit different version for it to work. And I'll get to a couple of those in our example. Be like, I'm not really sure how the question works for that one. It does. You just, it's just may not be as obvious. Some of them are a lot more obvious than others. But basically, we're going to ask ourselves, what did the business get? That's going to be our debit question. Whatever we answer to that, whatever account we answer, that's what we're going to put as our debit entry. And then we ask ourselves, okay, we know what we got. How did the business get it? Whatever it is. And that's going to be our credit question. Whatever answer we come up with, the account for that, that's going to be what our credit is. When we're doing journal entries, we always have to have at least, could be more, but nevertheless, has to have at least one debit and one credit. Okay, now let's begin to put this into action. I want us to, you might want to keep this up. This is gonna, these two questions, or have them off to the side that you can easily pull up. But what I want us to do at this point is to get out the tailors, and we're gonna actually just jump in and try a few of these. So over here on the side, I'm going to have the transactions that happened in our brand new business. And then over here, we're going to go through the answers. So now for you to get the most out of this, to get the most out of this isn't just to sit back and listen. In accounting, you're going to find that for some that can work, but that's not typically the case. You actually need to go in, get out a T account sheet like this, get out a blank one, just pull it up from, hopefully you already have one up, and make a separate little sheet down here. Just hit the little plus sign, and this will be, you'll want to make this our journal entry sheet. So we could call this our journal entries. And in the top, we'll call this date, put our date here, and then we'll put our transactions here, accounts that we're going to use. And then over here, we're going to have our debits amount and our credit amount. Let's just call it debit and credit. Now, for the transactions, you can see these aren't really dates. I just have them listed in numerical order. So if that's the case, we just call this date number 1. And then we'll be able to begin to journalize and keep track of everything that's going on in our business. Once we journalize it here, we're then going to go back to our T accounts in the general ledger and insert the amounts in the appropriate places. And I've got, we're going to fill in some of these. We may need to add or alter some of the account names. For example, if we start having an account payable, we owe somebody, I don't want to keep it company one. I'm going to actually take out company one and put in the real name of the company that I owe. These accounts are not set in stone. These are just to give you an idea of what accounts go in here. So if I need to, I can easily add in new accounts, or I can change the accounts that I already have and move them around. So if I don't have any prepaids, prepaid rent, prepaid insurance, anything like that, I can call this account 111 and make it AR company number 2. And if I need to, I can count this as AR number 3 and then make a new inventory somewhere down below. I do want to keep them in order. I don't want to come down here to the bottom and put an account receivable, because that gets things out of nice, neat order. Because if you remember from last time, these long-term items, these are items that aren't going to change very much. They're going to sit there in our accounts because we have a big piece of equipment and it just gets used. Doesn't go back and forth. But supplies, on the other hand, those do go back and forth. We get some and then we use some. And then we get some more and then we use some more. So we're constantly getting some and then using some, getting rid of them. So that's why those accounts, we want to keep those active accounts up here towards the top, those current accounts. All right, so let's just jump in here. Go ahead and have up these 2 items. It's going to really help you to really begin to get this stuff down. I would just either do it on a side sheet or just do it right here in Excel. It's a lot of times easier. Okay, so for this first one, Tyler invested $30,000 into the business. And so all we're doing here is putting things into the T accounts and then preparing the journal entries. You're going to begin to have one way or the other that you like to do things. Most people, once you kind of get accustomed to how journal entries work, most people do the journal entries first and then go into the T accounts. But sometimes it's best at the very beginning, like now when we're just learning this, to do the T accounts first, because you can see the plus minus and make sure that you have the correct account in the correct spot and not vice versa, not have something be a credit when it should have been a debit. All right, so Taylor invested $30,000 into the business. We got to ask ourselves, what did the business get? And this one, it's pretty straightforward. The business got money. The business got dollars. So when I go into my T account page, and this is, I'm gonna be doing it from, you can go ahead and, yours is gonna look like this, but I'm gonna be building T accounts as we go. That's just how this one I have laid out. But in a sense, you're gonna be putting number 1 here, and that's what I have here, number 1, under the cash account. And then we're putting that as a debit. And then we got to ask ourselves, does it make sense that the business's cash went up, that it had increased 30,000? And yeah, it makes sense. And then the credit question, remember the first question is, what did the business get? The credit question is, how did the business get it? Well, Tyler invested it. And whenever the owner puts money into the account, that's when we come over to the owner's equity and we put it here as either capital or common stock. Now the book is going to be using the term common stock. So that's what we'll get used to doing as well. And insert the term capital or common stock, either one. I think for this example, I use capital, but you can easily just switch out that name and put in common stock. So over here, in my owner's equity, I have 30,000 on the plus side, and my date is number 1. And then remember back to our last class session, we said the accounting equation always has to equal. And it does. If we look up here, the equal sign is, and everything to the left, it's just 30,000 because that's the only amount that we have, 30,000 plus. And then over here, on the other side of the equal sign, it's also plus 30,000. 30,000, it's a positive number. It's on the, on the positive side. And in our equation, it's plus. So 30,000 does equal 30,000. Now we're ready to do the other piece. We're ready to do the journal entry. The journal entry, we're in our date column, we got our number 1, number of first transaction. And then if we need to remember what account was our debit, what did I get, what did the business get? We got cash, 30,000. So that I'm going to put as my debit right here along the left-hand side of the whatever column I'm using. And then in the debit column, I put the amount of cash we got. Then we don't have any more debit. You could, remember you had to have at least one debit and one credit. So we could have gotten more items than just cash, but that didn't happen here. We only got one thing in this transaction. And then we ask, how did I get it? How did the business get it? Well, we got it from the owner. And whenever the owner puts stuff in, we call that capital or common stock. And notice how I have debited, or I have the debit up here. And then when I credit, I indent. And then I put the credit over here and under the credit column. Okay, with that, we can go ahead and move on to number 2. Not only will the owner necessarily invest cash, usually they definitely invest cash, but they can also invest other personal items, non-cash items into the business. Things that if they ever sold the business, they would either A, want to get it back, or B, the business would pay them personally for it. So in this example, Tyler put in a barber chair. He's not wanting to donate the barber chair and then whoever takes the business over when he's done or retired, he doesn't want the barber chair just to go along for free with the business. He wants to have that value in there. So when it's time to sell the business, that barber chair, he knows that it was his and he's going to hopefully want to be compensated for it unless it's just been worn out. So Tyler also invested a barber chair, or Taylor. He bought it 5 years ago. That doesn't matter. That's just showing that he had it personally. So we ask ourselves, what did the business get? And when we're looking at our T account sheet, this is where at first in accounting for most students, it's the hardest to think, okay, what did I get? What's the debit and credit? Well, you think, okay, we got something. The first instinct then is if you get something, you think, okay, it's got to be an expense. But if we remember back to an expense, if we go back to our sheet from our notes and what we did on our last class session, for something to be an expense, usually you get the benefit of something. Okay, we got the benefit of the chair, getting the item. We've got to meet these 2 criteria though for it to be an expense. Is the company receiving the benefit now? Am I getting the chair now? Yes. So that's okay, we're good there. Will this chair last me less than 1 year? And the answer there is no. That's going to be the holdup. We can't call that, and we can't call this chair an expense because it's not something that we're just using right now and then only right now. So then that takes us back up to assets, things that we own or have the rights to own. Yep, that's the case here. It's something that we own. It's a piece of equipment. So I'm going to come down here into the lower part of the assets, and I'm going to add an equipment account. So I'm in my assets here. This is my previous transaction. We go down towards the bottom, and we put in the equipment. And then I even label it equipment-chair to to remind me exactly what the equipment is. And then I've got to think, is the chair worth a positive 6,000? Remember, it's plus minus has a debit. And yeah, that makes sense. We don't want a negative value chair. So that's what I got. And then I asked myself the credit question, how did I get it? And well, I got it from the owner. So just like getting cash, the same thing happened. We're going to debit our capital or common stock. We're going to credit our capital or common stock. So not only did the owner give us $30,000, he also gave us another $6,000 of stuff. So this just shows me that the owner has put in $36,000 of value into the business so far. Got my date here as the number 2 item, and then we're ready for the journal entry. Okay, we get our date off here to the left. Make sure you skip a couple lines, 1 or 2. And then we list our debit and our credit accounts. Our debit was the equipment dash chair. That's what it was, the chair. And it's valued at 6,000. And then how I got it through the owner investing it. So we call that capital or common stock. Also valued at 6,000. Now, when I go to number 3, Taylor paid for advertising, $900 worth. So we ask ourselves, what did we get? We got the benefit of advertising. Our product is going to be shown somehow, radio, billboard, TV, and we're going to get the benefit of that. People are going to know about our product. That's getting the benefit of something. And first thing we think of, hopefully, we'll get used to this, is if we get the benefit of something, it should be an expense. An expense is we are getting the benefit of something that will help us make money. That's how you got to think about it. Does this help us make money? And it does. Then we think, ooh, okay, we got to answer the 2 questions for something to be an expense. Is the company receiving the benefit now? Yep, we're getting our advertising right now through however means. And then will that advertising last us less than a year? Most likely. There isn't, I don't know of hardly any advertising that you pay for that you continually get benefit of it after a year. It's still out there running whatever. Usually, even if it's a billboard, it's only like 6 months or less. So yes, we can call this an expense. And we have one in my generic T accounts called advertising expense. Notice in the advertising expense, the debit side is the only side that's really lit up. I put no over here in the credit because if you look at plus and minus, it doesn't make any sense that you got a negative benefit from something. If you get the benefit from something, it's positive. You don't get a negative benefit. So you won't, I can't say never because there is one little caveat. Whenever there's a correction, we got to do it. But as long as there's no errors, then we'll never have a credit expense. You just should not have a credit expense. So when we go now to our, let's pull up our sheet and let's look at, we come over here to the expenses. And since this is the first expense, that's why I just have it first. Number 3 here, we're debiting our expense. It's on the debit side. It's a plus. We got the benefit of $900. And then I ask, how did I get the benefit of the advertising? What did I have to do? Well, I had to pay money. It says I paid $900. So if I paid money, we come over here to cash. We don't have $30,000 in our bank account anymore because I just wrote a check for $900. So our bank account went down, decreased by $900. Now we look at the journal entry. The journal entry, once you have the T account down, the journal entries are are simple. And it goes both ways. If you do the journal entry first, once you have that down, the T accounts are simple. You just put it right in, put the numbers right in. So account number 3 or transaction number 3, debit our expense and credit the cash. Now, there is one thing that I wanted to draw your attention to, and that's in the accounting equation. Notice here that this brought our assets down by $900. Because in it, I keep a running total at the top. So you see this and you think, well, these two together don't equal 35.1. Well, that's because you're forgetting the equipment down here. I put a lot of space in here so we would remember that this is down at the bottom. So this decreased our equation by 900. And then you come over here and you think, uh-oh, this increased my equation by 900. Well, that's true and not. Yes, it did increase my expenses, but when I'm looking at the equation, this minus sign in the equation overrules. It says whatever this positive is, it's going to become a negative in the equation. So we had negative 900 on the assets, and then in the equation, we have minus 900 in the expenses. So it still balances. Okay, number 4, Tyler purchases some supplies. That's the key word here, our supplies on account from Miller for $1,200. Now, we just got the supplies. We haven't actually used them yet. So that's why we don't necessarily, and this is how the questions in the book will go too. So that's how I'm going to teach it. We would ask are we receiving the benefit of those supplies right now? And the answer is no, we're not really. We just bought them and then we're going to use them next week, next month, whenever it is. That's when we'll expense it. Because that's when we get the benefit of it. So for now, the supplies are simply items that I own. And if you look in your T account, we have an asset account called supplies. And this is where we're going to put it. Okay, so let's go to our answers for number 4. What did we get? We got supplies. I'm going to move this over. Our supplies, number 4, it went up 1,200. And then the credit question is, how did I get it? Well, on this one, I didn't pay cash. It says I bought it on account from Miller, meaning they will send me a bill in the next couple weeks. They'll accumulate a tab on me. And right now, I owe them $1,200. So I don't want to just go to my cash. I want to come up here to my liabilities to show that I owe money. And then I'm going to take out company 1 and put in Miller, because that's the company that I owe. So what did I get? I got supplies, that's my debit. And credit, how did I get it? I got it because I owe Miller a positive $1,200. Now we come to journal entry number 4, and the journal entry is going to look just like what we did on the T accounts. We're going to debit the account that we got supplies, and then we're going to credit how we got it. We got it on account, AP, account payable, and then who it was, Miller. That's the store we owe. And so I put that over here in my credit column. Number 5 is very similar to number 3. Says that Taylor pays the electric bill $100. So if we paid the electric bill, that probably means we got the benefit of electricity, something every business has to have. Everybody's going to have an electric bill. So what did we get? We got the benefit of electricity Now, and then we got to ask ourselves the two questions about expenses. Does this meet that criteria? Did I get the electricity now? Yep, I had to have that now. And does that electricity last me less than a year? Yep, it only lasts me for that day or that month, whatever it is for that cycle. So yeah, that meets the criteria that we're going to look at for an expense. So on number 5, we come over here and we add in a brand new expense. And on your T account sheet, we don't necessarily have a utility expense. So what you may want to do is come down here and take away the cost of goods sold. We're not going to look at that until week 3, or maybe the rent one. Rent's a pretty common one, so we may not want to get rid of that. Maybe you call this one utilities expense. Just take out the cost of goods sold, rename it. Easily do that. So I put that here in the debit. It has to be a debit. Expenses are always debit. And then I ask myself, what did I do to get the electricity? Well, it says I paid the bill, or I pay the bill. So if I pay the bill, I'm losing cash. Cash is going down by $100. And then my journal. I debit the utility expense for the $100. And then come down and indent the credit account. I'm crediting cash because I'm getting rid of some cash of $100. All right, number 6. After the first day, we rang up 500 in sales. And then when we looked at the drawer, we saw that there was 400 there in cash, and then 100, kind of like a little IOU note from Janie that says she'll pay me in 2 weeks. And we took her word for it, and we said, okay, we'll do it. So we need to journalize this. We need to ask ourselves, what did the business get? And you never, in accounting, you never just get sales. Sales is how you got something. You didn't get sales though, and you'll look at that on the T accounts, and that will hopefully make sense, and that's why I have a no in the debit column. When we look at sales, we never just get revenue. That's going to be we don't have negative revenue. So what did we get? We actually got money. We got $400 cash. So that's going to be one of our debits. And in this case, we're actually going to have 2 debits. So one of our debits here, number 6, journal entry number 6, is we got $400 cash. Our cash actually went up. But we also got something else because we got up to 500. So the other 100 had to come somewhere, and it came from Janie IOU. And in accounting, what we call an IOU is an account receivable. We're going to be receiving $100 from Janie. You don't want to put that over here because that would show that Janie owes me a negative amount of money, and that doesn't make sense. So now we have 2 debits and no credits yet, so we're not done. We now have to answer the question, where did these come from? Why did I get 400? Why does Janie owe me 100? And the reason the why is because I made a sale. Because I made a sale, that's why I got that stuff. I got cash because I earned the revenue. I did my job. And notice here, you can lump these, both of them together, the 400 and the 100, into one credit account, because both of these came from the same spot. The cash came from revenue, and the IOU came from more revenue that I earned. So I can combine, instead of having a 400 and a 100 here, I can just combine it into one 500 amount on the Y part. And then the journal entry will look like this. We have our debits at the top, both debits. I usually like to put them in order of the numerical value, but that is not a requirement. You do not have to do that. You do have to put debits first, but you could have put AR Janie first. I just like to keep them in numerical order. And then we come down here and just show our service revenue. As for the why did I get these two? I got both of these because I did my job. And if we go back, we can answer that. We can make sure we've answered these two questions back in my notes from what we did in our past class. The two gap requirements to have something considered revenue is the company was paid or promised to be paid. Yep, I either got the money or promised from Janie, and the job was completed. And that was also the case in my example. It would have had to tell us that the job wasn't completed, meaning we offered out gift certificates, the company paid us in advance for services to be done later. We would have had to note that. Otherwise, we say, yep, the job was done. Okay, two left, and then we're going to start totaling things up and preparing the trial balance. Taylor paid $200 on her account at Miller's. All right, now this is one where it's not quite as straightforward. That we still have to, we can think about it and eventually it'll make sense. But you ask yourself, what did you get? If you pay on your account to Miller, you still get something. It's not something that you can physically touch, but you still get something. And what you actually get is, well, you owe Miller less money. That's what you're getting. You no longer owe Miller whatever the balance was, and we can go back and look at our T accounts and be like, oh yeah, our AP to Miller was $1,200. Well, when I pay them, what am I getting? I'm getting a reduction in what I owe. I'm not getting whatever it was that we bought from Miller. Remember, we bought supplies. I'm not getting that. I already got that back in journal entry number 4. What I'm getting now instead is a lower balance on my bill. I now owe $200 less. So if we would combine these at this point and put a balance down here, I would now only owe $1,000 instead of $1,200. So if this is what I got, a reduction on my balance, I then ask myself, why did I get a reduction on my balance? And most of the time, it's because you paid cash. So you wrote a check, your cash went down $200. The debit and credit for this one, we debited the account payable for Miller. I owe them less money. That's what I got. And I owe them less money because I paid them money right now. Okay, our last example. Advertising is doing really well, and we want to take advantage of getting advertising for next year. So we go ahead and buy it now. But it's not going to go into effect until next year, until January and February of next year. So whenever we get the benefit of something, we always call it an expense. But remember what the expenses say. You have to, is the company receiving the benefit now? And the answer is no, we're not. So if we're not getting, usually if something is not an expense, it usually reverts back up to an asset. It's something that we either own or have the rights to. And we have the rights to future advertising. So we call that a prepaid expense. If you look at your T accounts over in the assets, I have one prepaid account, and you can just rename this and call it account 120 prepaid advertising. And that's what I did in mine. I called it prepaid advertising. Prepaid advertising went up $1,300. That's what I got. I have the rights to that advertising next year. And then I asked myself the second question, why did I get the rights to the advertising? I got the rights to it because I paid for it. My cash went down. That cash went down $1,300. Go ahead and put this into our journal entry. Debiting our prepaid advertising and crediting cash. Now, what the, and when we're doing examples in our homework, sometimes the computer program will have the T accounts added up for you. Sometimes you'll have to do it yourself. So that's what we're going to do now, is go ahead and make sure we know how to, once we have all the accounts done, it's time to total our accounts and then put a total up here for our total parent account. But the first thing is first, we need to total each account that has numbers in it, more than one number. If it just has one number, then that is the balance. So off to the side, we're going to put BAL whenever it's time to make a balance. And you don't have to put it at the bottom. You can put it right here, right below. You want to have like a cutoff line. I usually make it a dark line. Come up here and I highlight these cells, and then I come here and put on thick bottom border. And how we get this amount, we never want it to be over here in the negative side, our balance, because we don't want to have negative cash. That doesn't make sense. What I want to do is I want to add up everything in the left column and then subtract out everything in the credit column. And you can do this on a calculator, or you can just have Excel do it through formula. And that's what I did. It makes it so I don't make any adding errors. I said, okay, take column B, add everything up here, and then subtract everything over here in column C. And when I do that, I get a balance that says in my cash checking account, I have $27,900. Now, when I come down to the AR and the prepaid and the chair and the supplies, everything else, they all have just one number. There's no need for me to total these up. These are self-explanatory what the balance is. So once I have everything added up in a particular column, like the assets, and remember the assets kind of come down and over right here. Once I have everything, then I want to go through and add up each of the totals. So what I did is I said, okay, let's equals this total. And then let's add in all my other balances, and they should all be debits. My AR, my supplies, my prepaid, and my chair. If I add up all of those, it says my total assets are $36,500. Now that tells me that everything over on this side of the equal sign better also be totaled up to $36,500. And that's what we're going to make sure now. So we come over here to account payable Miller. We have two items. Yep, I need to go ahead and put a balance here. So I'm going to put BAL, tells me it's a balance. I got a solid line. Solid line tells me that whatever is below that is not a transaction. It's just a summary. So I just took my positive amount and subtracted out my minus account to get 1,000. Notice it goes over here on this side. It's on the positive side. My balance is a positive 1,000, not a negative. And that was the only liability I had. So that's real easy to add up into my parent accounts. It's just this total. It's also easy to add up my capital. My capital was the only owner's equity account that I had. All I did is summed up the two amounts here, 36,000. and simply put that up here because that's the only account that I have in the interest equity. Revenue, didn't even need to total this one. Also over here, make sure we have our balance line. For our revenue, $500, no need to total it. That's the only revenue we had, so my total revenue is $500. I don't need to total any of the expenses. I didn't have any expenses that had more than one amount. So when I total up all of the expenses, my 900 and the 100, it comes out to 1,000. Now, the final thing I want to do is I want to combine all of these into one formula and make sure that if I add up all of these off to the side, does it equal 36.5? So let's try it. So out here to the side, I'm going to add in the liabilities. And then it says, okay, plus this. And it says plus 500. And then it says minus this. I add all of those up, 36.5. And that equals my assets. Now, once we have that, we're ready for our final step. And I'm going to make a new sheet for this. And you'll want to make a new sheet. We're going to call this our trial balance. Trial balance is what you were given last time, and in order to make the financial statements. Now we're going to actually make the trial balance, and then we can use that to make the financials, and that's what the homework is going to do. And we'll go through that once we go into some of the problems. So this is our last step in this problem, is to make the trial balance. So what I want to do is first make my proper title. This is called Taylor Salon Service, so I'm going to put that title up here, Taylor Salon Service. And then put what it is, trial balance. And then as of December 1, 2017, it's obviously a few years old, but that's fine. Now, when we make a trial balance, we always put our accounts in order down here. And then we have a column for debit and a column for credits. So what we want to do is we want to take every single account that has a balance and put it into the trial balance. And so everything has one final number. That's what the purpose of the trial balance is, to put everything in correct order and then show its final balance either as a debit or a credit out here. Okay, so let's do that. Our first account is always cash. And then I'm going to link it so I don't have a typing error. I know that my final balance here was $27,900. And so the $27,900 will show. And then I knew I had an account AR to Janie. And since the trial balance is just for my eyes only, I can call this AR Janie, or I can just summarize all of my ARs. Either way is okay. Since we only have one, I'll keep it with AR Janie there. And I come down here to AR Janie, $100. And then I remember my next one was my prepaid advertising. $1,300. Then my next one I had was supplies. And then finally, my last asset account, my long-term one, was the equipment. $6,000. Typically, you don't necessarily space here. too, because I like it to be easy to read. I like the trial balance to be kind of keep things in their separate areas. So I'm going to put my first liability, and actually it's my only liability, my account payable out here, and I forget who it was to, so I'll have to fill that in a second. And my final balance there, it's to Miller, $1,000. And no, remember, it's on the credit side. So I need to put the 1,000 on the credit side over here. And I'm going to go ahead and put in AP Miller. I'm going to go ahead and skip another line, because I'm starting my owner's equity. And I only have one of these as well, common stock. Common stock or capital, either one, was $36,000 on the credit side. So I need to have this on the credit side. And then I have service revenue. Was my next T account that I had used. It was $500 on the credit side. And then finally, I had my two expenses, advertising and utilities. Okay, so let's put in our advertising expense. It's on the debit side because its balance is on the debit. And my last one was the utilities expense. It's also on the debit side. All expenses are debits for 100. Now, there's usually three things you have to do when you do a trial balance. One, you get all of your accounts in their proper order. So assets, liabilities, owner's equity, revenue, expenses, that's proper order. Second, you put in their final balances in the correct column, either the debit or the credit side. And then third, you draw a little line, get your draw a line, put your thick bottom line down here. And now we want a total. And our totals, when I total up all of my debits, it better be the same as all of my credits. That's how I'll know if I've most likely done it correctly. Doesn't mean I definitely did it correctly, but it doesn't, if they don't balance, then that definitely means I have an error somewhere. So I'm just going to copy this formula, pull it on over. So the total for all of my column C is 37.5. Remember, that's different than my debits, and that's fine. My assets were 36.5, but that's only the assets. My trial balance is looking at all debits, not just assets. And then my credits look at everything in column D, and it too is 37.5. So that tells me that I probably have everything correct. Now, what we would do at this point, and we're not going to do it in this example, but then we could take all of these accounts and start making our financial statements if that was where we were at. We didn't have any other entries to handle. Remember that we would do our income statement, and then the statement of retained earnings, and then the balance sheet. Okay, let's take a 10-minute break. Let's come back at about 10 or 11 after, and we will, in probably two separate segments, we're going to go through some of the examples in Connect. So go ahead and bring up the IB Learn module and have that ready to go, and we'll be back in about 10 minutes.